Welcome back to the program. It's Thursday, March 28th. I see Sam Bankman-Fried sentenced to 25 years, $11 billion fine. Prosecution wanted 75 years or more. Bernie Madoff, who committed fraud in a similar way, got 150 years. Remember now, Sam Bankman-Fried was a major donor to Democrats. And it might seem like 25 years isn't quite enough. Seen some other people have done similar things get about the same. But this is the biggest fraud in American history. 25 years, and you know he's not going to serve all 25. A little bit of a letdown there for those who are looking to see justice come down hard on this guy who just ripped people's eyes out. Blatant fraud. Theft, really. 25 years. Sam Bankman-Fried. I want to check in on President Biden's comments on the collapse of the Francis Scott Key Bridge in Baltimore, 695. This guy can't help himself. The president pledged on Tuesday that all the federal resources they need as we respond to this emergency. Says we are going to rebuild the port together. The port is not in jeopardy. The port does not need to be rebuilt, just the bridge, Joe. He went on to say, it is my intention that the federal government will pay for the entire cost of reconstructing that bridge, and I expect the Congress to support my effort, he said deliberately. This is going to take some time, but the people of Baltimore can count on us, though, to stick with them at every step of the way until the port is reopened and the bridge is rebuilt. Where does he get off pledging that the United States is going to pay for the entire cost of the reconstruction of the bridge? Way out of bounds, way out of bounds. Congress has a role in this for allocating money. It starts in the House of Representatives. Now, Transportation Secretary Pete Buttigieg says that they have $950 million in emergency funds for emergency use, obviously implying they might use that money. But no. Now, if the federal government wants to finance the reconstruction, wants to lend the money to the contractors, fine. If you want to help expedite the reconstruction, which I think is a wonderful idea, we need to move as quickly as possible to rebuild this bridge. But the Singaporean government and Maersk, who chartered the ship, should be responsible. The registered container ship is owned by Grace Ocean Limited from Singapore, leased by Maersk. They should be the ones to pay for the bridge, and their insurance companies, not the American taxpayer. Now, again, expedite it, help fund it, fine, but we expect to be paid back. We're $34.4 trillion in debt. Biden's been running trillion-dollar deficits or more for over 3 years now, every year. 2024 deficit projected to be $2.4 trillion. We don't have the money. Again, help finance, fine. But payment for the bridge, that's on the shipping company and insurance companies. And again, speaking of the bridge, we're going to have some real economic calamity here. For getting the distribution and transportation of goods through the port, we're going to have some serious job impacts. The port's going to be closed for a while. We're not going to be unloading or offloading cargo. Truckers are going to be out of work. The workers in the port are going to be out of work. We're talking thousands of jobs here impacted as a result of this bridge collapse. We have to work quickly, and I hope he does. I hope the Biden administration works as quickly as they can and helps in any way they can. But the U.S. taxpayer should not be on the hook for this horrible, horrible accident, which is what it was. But no, insurance companies, the owner of the ship, and the company that leased the ship should be on the hook for repairing the bridge. Other thing got my attention today was Janet Yellen, our Treasury Secretary. I feel bad for Janet Yellen. She's in her 80s. And she's stepping out to essentially support what are largely lies, misrepresentations of President Biden's agenda. She was on MSNBC, or what some people are now calling MSDNC. I love that, MSDNC. It is really a propaganda tool for the Democrats. She was interviewed by Andrea Mitchell. The Treasury Secretary Yellen stated that a key plank of President Joe Biden's agenda to lower costs is by creating incentives to dramatically improve the use of clean energy in the United States. And over time, this will help lower household energy costs. No, it will not. She knows it will not. I feel bad that she has to make that statement. And listen to the question Andrea Mitchell asked. Talk about a setup. How can you, I know you're in Georgia today, help get the message to people that the economy is better and improve it even more, get these grocery prices down, help bring down the prices that people are feeling at their kitchen table? Right? So again, they're a mouthpiece for the White House. The White House wants you to realize that the economy is doing great, regardless of how you feel personally or how your economy has changed since President Biden came into office. And so the setup was pretty blatant. So Yellen responded to the question So the president has indicated, and I certainly agree, that getting the cost of living down should be our number one economic priority. Yes, although they've done nothing, absolutely nothing since January of 2021 to bring that about. They have done the absolute opposite. The only reason inflation has fallen is because of the Federal Reserve and you and I changing our consumption habits. And she goes on, and he's proposed many different ways of doing this. But one important way is by lowering energy prices and diminishing their volatility. Has done nothing to help energy prices, the exact opposite, trying to restrict supply, trying to change demand. Right now, she continues, when Putin invades Ukraine, or there are supply disruptions in the Middle East, and there haven't been, except for the Red Sea, which haven't been too impactful yet, we can see oil and energy costs skyrocketing, harming American families. Yes, and his actual efforts to restrict fossil fuels. Don't forget that. She went on, and the Inflation Reduction Act is a comprehensive piece of legislation that's creating incentives to dramatically improve the use of clean energy in the United States. Well, finally, we have someone from the administration admitting that the Inflation Reduction Act is misnamed because it's really nothing more than a Green New Deal. Bringing down the cost of living, she's not talking about next week or next month or next year. She's talking 10 or 15, 20 years from now. And so does nothing to solve the current inflation problem we continue to find ourselves imperiled by. Inflation's running at 3.1, 3.2, 3.3%, generally, well above the Fed's 2% inflation target. And we can all see it, we can all feel it. And on that topic, I noticed a story coming out of Texas and a cautionary tale about green energy. A large-scale Texas solar farm, over 3,000 acres, if I'm not mistaken. I can't believe we have solar farms that large. Think about that as one example of how much land we'll have to give up if we're going to try and transition away from fossil fuels to solar. Think of how many hundreds of thousands of acres we'll have to provide of solar fields to replace fossil fuels. But unfortunately, on March 15th in Texas, there was a major hailstorm. It just blasted thousands of acres and thousands of solar panels. It was like somebody shot a shotgun into these things. It's an area about 45 miles southwest of Houston, the Fighting Jays Solar Farm, a joint venture of Copenhagen Infrastructure Partners, again, foreign nationals involved in our Green New Deal, and AP Solar Holdings, LLC. Promises 350 megawatts of capacity. Well, not anymore. Do a little search online for Fighting Jays Solar Farm and take a look at the damage done to these solar cells as a result of a single hailstorm. Do we want to be dependent on energy for a source of energy that can be ruined for many, many months and years? This is going to take a whole lot of time to repair, if at all. That can be taken out by a hailstorm, which we have regularly, and hailstorms usually occur in sunny areas. All right, some data, shall we? We spark blast on Tuesday. Let's check on data and markets. Not much out on Wednesday. MBA mortgage applications for the week ending March 23rd, down 0.7%. 30-year mortgage rate, 6.93%, a little lower than the prior week. 2 weeks in a row of negative MBA mortgage applications. Not surprising again, high interest rates and high home prices. That's all we had on Wednesday. Today, Thursday, as always, at 8:30, we had initial unemployment claims for the week ending the 23rd. 210,000 of fellow Americans lost their job and filed for initial unemployment claims. And I'll just say it again, I've said it every time I talk about claims data, this is bogus. This is fugazi. Something is wrong with this data. It's been stuck at the low 200 level for a few years now. And it can't be. We've had announcements of hundreds of thousands of layoffs over that time period and no impact on claims. Something is going on here in manipulation of this claims data. I suspect if President Biden doesn't get reelected, we'll see quite a transition in January, February of 2025. Also out today, Chicago Purchasing Managers Index for the month of March. Ooh, big fall, 41.4 versus 45.9 expected versus 44 in February. Really bad number. Below 50 is contractionary. Chicago PMI, the Purchasing Managers Index, reflects real economic weakness out there, in particular in the manufacturing sector in that region of the country. Also today, we had the final revision for fourth quarter GDP, a little tick up to 3.4%. Good number. Costs a lot of government debt to get that number, but nonetheless, that's the case. And Joe Biden's going to squeak out 2023 with a little bit of a 3.0, 3.1% GDP growth. So we escaped the Obama curse. During the 8 years of President Obama's administration, didn't have one single year of plus 3% GDP growth. Also today, we had the final revision for Michigan consumer sentiment for the month of March, 79.4, a little elevated, but lower than we've had for in Q3 and Q4 of 2023. And then lastly, we had pending home sales for the month of February, up 1.6%, a touch higher than expected of 1.4%, and better than the January number of down 4.7%. Even with that number, we are just off the all-time lows for pending home sales. Just off the lows. So not good. High costs of homes, high interest rates are complicating pending home sales. Pending home sales are homes in contract waiting to go to closing. Now, one of the challenges we have here when it comes to pending home sales or existing home sales is that for the past few years, 3 or 4 or 5 years, mortgage rates have been in the low 4s, even the mid to high 3s, almost free money. 3.5% mortgages, 3.25% mortgages, 3.75% mortgages, 4% mortgages, really low interest rates, really low monthly payments. And now if you want to sell your home, get some equity out of your home, for instance, if you're going to sell and buy again, you're going to be paying 7% interest. Your mortgage payment will double. A lot of disincentive for current homeowners to sell their existing homes if they got it in the past 3 or 4 or 5 years because they got historic low interest rates that are tough to nudge away from. Let's take a quick peek at markets here before we have, again, another snapshot. This is near the close on Thursday. What a surprise. The S&P 500 is up another 12 points at 5,261. The bubble continues to expand. S&P is relying on good corporate earnings to continue, which have been a little mixed. But most importantly, they're relying on the Fed to cut rates later in the year as a basis for increasing stock prices. But really bad news. That's a bubble. It's going to correct. We're going to see a serious correction, likely in 2024, if not definitely by 2025. Checking bonds, our benchmark as a proxy, the U.S. 10-year bond, 4.21%, up 1 basis point, about where we left it on Tuesday. Not a lot of action in the fixed income market this week. It's been relatively quiet. Want to see that 10-year move towards 4.5%. West Texas Intermediate oil, $83.09, up $1.74 on geopolitics and the constraints in the Port of Baltimore. Nat gas, $1.74, up 2 cents again. Geopolitics and the constraints out of Baltimore. Gold, $2,241, up $29. Uncertainty remains, and so buy gold. U.S. dollar index, 104.55, up 20. Continued dollar strength, buy dips in the dollar. Dollar against the yen, 151.39. The Bank of Japan and the Japanese are getting very nervous about this weekend. These are 36-year highs in dollar yen. Dollar against the British pound, 126.20, about unchanged from Tuesday. Euro against the dollar, 107.90, down another 40 points, broke the 108 level, important psychological level there. So higher stocks, interest rates about unchanged, commodities bid, gold bid, dollar bid. All right, that's all I have for you today. Happy Easter. Always try to buy American.